first of all, here, let's have a look at today's agenda. And how herd, the questions we want to answer is how herd mentality manifests in trading. So herd mentality, by the way, I can mention it already right at the start here, is also something we know as bandwagon effect. It's a classic cognitive bias. What this is, some of you probably recall one of the topics, the webinars we had in the past on behavioral economics, behavioral finance, and the cognitive biases. So herd mentality / bandwagon effect are also cognitive biases, which can be of high interest, probably especially in the current market environment with this nearly parabolic move higher in equities, especially US equities. Then, sure, we want to answer the question, is it a good or a bad thing? Cognitive biases, some of you probably remember, okay, there was something negative connected to it. It can be positive under several circumstances, special market conditions. But this is something also we want to look at here. And then also, yeah, surely we want to answer the question. It's a sub-question of the second point, in fact, when to follow the herd and when to steer clear. And before we start, sure, we could now start talking about me. Probably this is not the best idea, because everything you want to know about me can be found in an interview I had with Admiral Markets in July last year to give an idea on where I come from, what is my background, not just from an educational perspective, but also especially from a trading perspective. What's more interesting is probably, or the most interesting thing is probably that I'm located in Berlin, in Germany, and Admiral Markets here has offices around the globe as a global provider of financial services, especially when it comes to Forex and CFD trading, with offices around the globe, over 8,000 financial products, and one office is located in Berlin here in Germany. So I have a direct connection to the German office and to the Admiral Markets here. And yeah, this is where the connection comes into play. Definitely feel free to reach out to the website, admiralmarkets.com. Again, 20 offices and more around the globe means you have a high likelihood of finding someone, especially in the service department here from Admiral Markets, who is speaking your native language and gives you all information you need, or answering all your questions you may have. Feel free to reach out to the website, admiralmarkets.com first, and then find out more about the offering. In regards to the DAX, one thing I'd already mentioned several times, and I want to, I'm not getting tired to mention it over and over again because it's noteworthy. In Germany, we refer to Admiral as the so-called DAX expert, with a probably the most competitive DAX CFD offering in the market here. So in regards to DAX trading alone, it's definitely worth to give Admiral a look. Nevertheless, you also should have a deeper look into the offering in regards to FX trading. Admiral Prime, for example, the platform where you, or the environment where you have a DAX 0.2 spread with a commission on top, you will also find highly competitive offering when it comes to FX spreads, especially Euro USD average spread, something between 0.1, 0.2 pips or something, and very stable. So definitely worth a look. But now let's jump into the action. So that's it around me, respectively, around Admiral Markets. Let's have a look here on today's topic, behavioral finance. I already mentioned it, cognitive biases. And let's have a quick intro here, or a quick recall on what we already know when it comes to behavioral finance. Some of you might have seen the webinar several months ago. Probably some have checked the Admiral Markets YouTube channel and have seen it. Still, we probably, it's not the worst thing now to go back to this topic, which is in fact a very special topic, and one which also has perfect or great literature, especially Thinking Fast and Slow from Daniel Kahneman. This is a book I highly recommend. You will find the link to the Amazon page here right below the video. If you're watching this recording now on YouTube, below the video, I highly recommend reading this book, because it's first of all, or at first glance, it doesn't have something to do when it comes to trading, and at second glance, you will find out that when trading the markets and all the emotions you're going through, all the feelings you might have, you find an explanation why this is the case, and also get an idea on how to overcome these emotions in your trading. in this book. So I highly recommend reading it from a personal and also a personal experience, and also when it comes to your trading psychology and your overall journey when it comes to finding yourself well equipped when trading the markets. So behavioral finance, a quick intro. We know that psychology in trading plays a crucial role. So there's some traders out there saying trading is 100% psychology. I disagree to some extent, even though I know what these people refer to and what they talk about. But I think profitability in trading comes with having not only a stable mind or a stable personality or the right mindset when it comes to trading, but it also is based on trading with an edge. So knowing that you have a strategy which is proven profitable, and also based on the knowledge of your advantage in the market and knowing your edge in the market, you have a clear and well-formulated risk and money management plan, which corresponds perfectly with your personality. And now you can already see it. Personality has something to do with psychology. Trading with an edge has something to do with risk and money management, also with psychology. But let's look at risk and money management, and there you can see that these columns, profitability and trading is built on, are strongly connected and interacting with each other, in fact, and they are dependent on each other. So if one column here in this regard is missing, it's very, very difficult to become profitable in your trading. So meaning if you can be as stable, you can be a stable genius. Oh, wow, that was a good one. So probably there's someone following Donald Trump on Twitter. Just imagine this guy is a stable genius. Let's take him as an example. And this stable genius does not trade with an edge. Probably he won't make it trading the markets. Now assume he has an edge, a profitable trading strategy, and let's assume he still is the stable genius, but he has no risk and money management plan, which gives him the chance to capitalize on his advantage. In the long run, he will still fail. So this can be easily adopted here to some extent, surely, on the current developments around the U.S. election. But let's just understand it that way, probably. And so psychology in trading plays a crucial role. It's a very important aspect. And one aspect to master this field here is surely to understand your emotions, where they come from, and then also formulate an idea on how to get rid of them, respectively, how to manage them so that that these emotions do not affect your trading in a negative way. So emotions, when we talk about this, we have anger, frustration, we have fear, self-confidence, and ego, and also motivation, actionism. We will refer to nearly all of them. To anger, frustration, or respectively, there's a gray area, let's say, between anger, frustration, and also fear. It's like you probably have heard about FOMO. FOMO is the fear of missing out. Big moves on the upside, for example. This is also something we refer to as the bandwagon effect. I can already say it right here, so that you understand where this FOMO, this fear of missing out, comes into play. Everyone is talking about, let's go 3 years ago, we had Bitcoin, this big bubble which built up, and Bitcoin was going parabolic, and we made it up to $20,000 US. I well remember one guy I worked out together with in the gym. And this guy also studied mathematics. So he's way younger than I was, but still, he knew about my my career path till then, respectively till now. And so he came to me and asked me what to do in regards to the fields he should go into when it comes to mathematics. When he also wants to choose a career path here in the financial industry, and he was also following the crypto bubble which built there, and so he was really like you could really feel his emotions, and then he really wanted to not only grasp the concept behind the world of trading, but he wanted to buy cryptocurrencies here because he thought that was a quick way to get rich. And I'm not sure whether he bought or not, but it was definitely not that he was looking for something like Bitcoin, where it all started with, let's say, and people then got connected to altcoins. But it was also that we was looking at something like Cardano or something, also crypto, which is not sure whether it's still available or not, where you can invest in it. I have no clue. But that was a perfect example, in fact, for the bandwagon effect here and the fear of missing out. Everyone else was getting rich. I can say that I did never and will never, in fact, invest in Bitcoins or in altcoins in general. I don't believe in this bubble which built there. So I love the concept. It's a very, very great concept which is behind that, and it's like easy, understandable concept, and it's from a mathematical standpoint, it's very smart, it's elegant. This is something mathematicians really like. So you can have a great proof on whatever problem, but at the end of the day, it's not only about the proof, but it's also about the elegance. And I think this whole concept behind cryptocurrencies and Bitcoin and everything is very, very elegant. Still, it's based the way the whole product is built here. I think it's easy manipulable. You can easily manipulate it, and that's something why I stand clear of that. And I don't want to really trade this actively, in fact. And so yeah, based on that, I was one of these guys who didn't become rich with that, and I know plenty of other guys who tried to get rich quick here, but didn't get rich quick. But at the end of the day, it all came down to emotions and the fear of missing out this big move on the upside, for example. So, but let's come back to the topic of today and how these emotions then, what these emotions do with you. These emotions, whether they are fear of missing out, fear in general of losing money, whether it's anger, frustration, if you have a losing trade, if it's like you're in a losing position and start you try to rationalize your position and you take out the stop, for example, and keep the position in hope that the market will turn around, whatever. All these emotions lead to something we know as cognitive biases. And these cognitive biases are defined as systematic and flawed tendencies when it comes to percipience, remembering, thinking, and judging, which impact your trading in a negative way. So it's should you go with something like the bandwagon effect, let's go back to the agenda and what I already mentioned, you should avoid it. Still, there's probably some days, some times when it probably makes sense to follow the crowd here, even though you have carefully to watch whether the situation goes extreme, respectively goes completely irrational, and something you definitely want to avoid. So let me just see. I just tried, by the way, to find the chat box. Where is it? Chat. There we have it. Okay, perfect. Okay, so that's it on the quick intro. On behavioral finance, a quick intro. It's about cognitive biases, and it's about emotions in your trading in general. So now let's have a look here at some examples of cognitive biases, even though I mentioned already some, but probably it makes sense to dig deeper into this topic because some of you, I mean, the bandwagon effect or herd mentality thing, this is something which is, based on my personal experience, not as common as one might think. Okay, yes, sure. When today, for example, reading a book on the history of the markets, and let's look at, for example, Reminiscences of a Stock Operator from Edwin Lefebvre, for example. This is the biography of one of the, if not the biggest trader of all times. It's Jesse Livermore, you probably have heard about him. So what we then usually hear about here is about the developments during the 1920s, for example, and the big crash happening at the end of the 1920s in 29. We are talking about the developments around 1987, for example, the Wall Street, which came down over 20% in one day on a Monday. We are talking about the financial crisis, for example, 2008, and huge volatility. We talk talk about Bitcoin, the bubble, which burst then dramatically, and still we're currently at least recovering some of these losses from 20,000 down to something like 3,000-4,000 or so, and now we're up to 9,000 again, and probably about to see 10,000 quite soon. However, the thing is that the bandwagon effect in this context, and the cognitive biases especially, and these manias which are developing there and which then burst dramatically, are not that common. So they happen sometimes, probably also in a smaller time frame and in a smaller environment. But in general, it's not such a common topic, in fact. But what's definitely something which is a big topic are the examples I've written down here, which can already show, or which definitely show you that these emotions and cognitive biases are something which are common in your trading in general, and one of the reasons why you should definitely be aware of them, respectively try to tackle them with techniques and try to somehow avoid them and the negative effects they usually have on your expectancy in your trading in general. So one cognitive bias, for example, is the so-called overconfidence bias. So what can be so difficult about buying low and sell high? So this is usually the most common example I bring in this context, something we refer to as Dunning-Kruger. I have to admit, I don't really know whether we made Dunning-Kruger already a topic in one of the webinars. I could imagine that, because I know we had trading psychology at one point, and then also a short introduction to this topic, but I'm not really sure whether we made Dunning-Kruger in a topic there or not. But usually it's that Dunning-Kruger says that people who don't know that they don't know can't know that they don't know, right? So that makes sense. So if I do not know what it takes to be a good trader, I just download the platform, let's say on the website from Admiral Markets, and I open an account there, and I just enter a trade. I don't know about the negative feelings, which negative developments when it comes to trading is in general affect, or how it feels to lose money or something like that. I just don't know about this, and so I can easily enter the market. There's no second guessing, nothing. And this is exactly what especially those people who don't know that they don't know do, and what we usually refer to then as a Dunning-Kruger effect here. It's this overconfidence. It can't be so difficult to buy low and sell high. And but also here is an excessive confidence in one's own answers to questions. For example, for certain types of questions, answers that people rate as 99% certain turn out to be wrong 40% of the time. So which is usually, and there you can also see a gray area here when it comes to hindsight bias. In fact, this is the third point. It's something I knew that the Euro USD would rise. How many times have you sat in front of your screen and thought exactly that? So you probably wanted to buy. Hey, Paul, let's have a look at today's DAX. So I haven't the chart open due to stability reasons here, but probably you have seen the developments, and it's a very choppy market action. So if you look at the DAX right now, what I can tell you is I have a trade open. Had a trade open, which didn't develop that well, because I was trading the long side. It's a system-based trade, and it was trading the long side. And I have to admit that I'm, to some extent, certain. Yeah, to some extent, I'm certain here, but I'm obviously in 99% of the cases, I'm certain I turn out to be wrong 40%. But let's say I could imagine that the market will rather sooner than later go for a test of the current all-time high. So if you have a chart open right now, look at the chart, and there you can see it probably. And that's one reason I felt very good in the trade, in fact. So it's a long position and system-based. I mean, I would have also taken a short trade, even though I'm not really confident in short trades in the current market environment, especially working out well. So I have an opinion of the market, and that's why I felt confident. And then you see that the market spiked slightly higher and then kept on drifting lower, and then we find ourselves right now, when looking at the lower time frames, in a very choppy market environment. And I was really stopped out on point. That the lowest point in the 5-minute chart, you can see that was me. I was stopped out there. And from there, the market just turned higher. And so, which is something I have to say, I sat in front of the screen. I did something else. I worked on another presentation in regards to our training spotlight series, in fact. But I still had the chart open. I looked at the chart and I said to myself, I know what will happen. You will spike me out there and then just go higher, right? And this is exactly what around something like 10, 15 minutes later or something developed. Right, that. And it's not that it drove me crazy, but still I was just shaking the head, just thinking, really, why? It's weekend. Can't we be friends and everyone's happy and, well, whatever. I knew that. Well, if I knew that, I would have taken, and this is what I want to refer to here, as a hindsight bias. If I knew that this would happen, I would have taken the trade out already 10, 15 points higher to save those 10, 15 points the long run. It has a positive expectancy on my trading. So, which means I didn't know that. That's something I know today, and that's why I'm not going crazy. Here, but still, this is something you probably know from yourself. You sit in front of the screen, you see the market developing in a way you are certain it will develop, and then it really happens, and you say, I knew that this would happen. The same is also true when it comes to, let's come back to US elections, for example. And if you asked someone in 2016, for example, how certain he feels about Donald Trump being elected the 45th president of the United States, you asked him before November 2016, he would have said, well, probably it's something like I could imagine it to be fun or something. However, that might turn out to be fun, in fact. But let's see. Well, right now we can see that it's not fun at all. But still, I don't think that he will be elected president and that Hillary Clinton will win the race. By the way, I'm referring to myself here. That's something I said exactly that way. And I know that because my webinars are usually recorded and uploaded on YouTube. And that's why I can and I will always be remembered that I said exactly that. But after that, it was like I knew, no, that's not true. But after Trump was elected, I myself was like, yeah, to some extent, I was certain that this could be a turnout, that this could be the result of the election, right? And this was something plenty of other people around me, family, friends, said themselves. That they said, yeah, isn't it such a, or is this a big surprise that Trump was elected because of this and that reason? Well, the thing is, you remember consequently yourself wrong in how likely you saw Trump to be elected president of the United States. So if you gave it a likelihood of, say, something like 30% before the election, if you ask the question after the election and you know the result, you would say, I thought that this would probably be something like 70, 75, probably 80%. The same is true also for the Brexit. So these are perfect examples for the so-called hindsight bias, that you remember consequently yourself wrong in regards to what could have happened here. And this is something which is definitely also true for trading. And we all know, I knew that euro US dollar would rise, for example. Well, if you were so certain, why didn't you go long? Sure, right? So why don't you, or didn't you put the money where your mouth is here? It's because you're not certain. And this is something which is perfectly illustrating cognitive biases in your trading here. But it's also the self-serving bias. So people's tendency to attribute positive events, winning trades, to their own character and decisions, but attribute negative events, losing trades, to external factors. Something I have to say I can well handle, at least right now. But when I started trading, it was really that I was sitting in front of the screen and I was looking for moves which went for me. And I was like, if I was positioned in direction of the market, it was my great analytical skills and my trading ability here, which was the reason for the plus in my trading account. While when I got stopped out, I was like, yeah, well, what shall I do? I mean, there's Draghi here, there's Morgan Stanley, Goldman Sachs fishing the stops. This is this and that and this and that reason. It's not because I took a bad decision taking the trade long, whatever, or short, whatever direction. And that's something we refer to as self-serving bias. We protect ourselves, which is, well, you can do that. I mean, at the end of the day, it's your decision, right? It's like in your life. If you say at the beginning of the year, I want to go to the gym, I want to lose, let's say, 10 kilos. Great. That's a great decision, right? 2 weeks later, you sit in front of your television, Netflix series, whatever. Here, a beer, and there is chips and potato chips, and yeah. Let's say you enjoy yourself. So you can do that. But at the end of the day, it's your decision. And if you say, yeah, well, it was such a difficult week, I'm so exhausted, I just deserve it. Fine, yes, but at the end of the day, you're justifying something which goes against your initial goal of, let's say, losing 10 kilos or something, just to give an example here. And so the same is true for trading. In the long run, especially when it comes to money, it doesn't bring you anywhere. It's just like, it's a self-serving bias, right? You try to protect yourself, but the market doesn't care about your personality or whether you're winning or losing. But at the end, if you take a bad decision, you just deserve losing money here, let's say. And then the market takes it away from you. It's nothing personal. And the market gives you clear feedback. So there's no discussion then anymore with the market or something. And this is also something which you need to get rid of, especially when it comes to for example, document your trading. Why I'm talking about this is very simple. If I asked during speeches, presentations, who of you guys sitting here listening to me right now has a trading journal, or who knows how important it is to have a trading journal? And then usually all hands are going up. And then I ask, okay, and how many of you guys have a trading journal and document all the trades? And then many hands go down, and they say, no, I don't have time to do that. I have a family, I have whatever, self-serving bias once again. But there's also another reason. It's like you're measurable in this moment. Once you have a trading journal and you document your trades, there's no chance of talk positive about your trading while your account is down, let's say 15-20%. There's only one reason. You are the one executing the trades. And so if there is a clear, clean minus in front of the accumulated sum of trade, well, then it's because of you and your decisions you've taken. You can go and make everyone else responsible for that negative event, but at the end of the day, that won't bring you back the money. And many people just don't have a trading journal, mainly because of the reason that they are becoming measurable and because of this self-serving bias, and that there's no real chance for them to make someone else than themselves responsible for the negative event. And then there's definitely something we mentioned. It's loss aversion. Let's come to the last point here. Cut winning trades short, let losing trades run. This is usually the tendency, to do exactly that, right? So you probably have seen that the market, which moved in your direction after entering, after the signal was generated, that you've taken out the trade after a short period of time, mainly due to the fact that you said, well, I'm not sure whether the market will still continue to move in my direction. And you, let's call it discretionary intervene with no real reason, based on pure emotions. And because here, if the market turns against you, the pain connected to losing the money you made so far hurts as twice as much as it feels enjoyable once the market moves in your direction. So this is a classic cognitive bias, which is called loss aversion, and which explains why it's so difficult to let winning trades run and cut losing trades short, in fact. And now let's come to the herd mentality cognitive bias here, which is also known as the bandwagon effect, something I already mentioned. And this is also known as the tendency here to do or believe things because many other people do or believe the same. I really like the explanation of this bandwagon effect, for example, when looking at Bitcoin, but some of you probably also recall the dot-com bubble around 2000. And back then, I was too young to have traded actively, even though there was one guy in my class back then with 14, 15, whose father opened an account for him, and he was trading some dot-com tech stock stuff. Not sure whether he made money or not, but at least today he is what someone would have expected him to become. In fact, he was always thinking out of the box, and he's an entrepreneur today, a successful entrepreneur, in fact. And then probably that was a first indication that there's some thinking when it comes to you have sometimes to take chances. What I found out myself, and if I remember well, I was like, it wasn't that I was jealous or something, but it was like, it was interesting, and everyone was talking about that. And the same is true also when I talked to my family, to my father, to my mother today, asked them about this .com bubble, and there's where lots of parallels come into play when it comes to the Bitcoin bubble which built. Everyone was talking about tech stocks. Everyone was talking about here in Germany we had the Telekom. It's the biggest phone company, let's say phone company, internet company in Germany. It's a state a company, in fact, which went private, and then there was the IPO, and there was lots of actors back then, very, very not successful, but celebrities, which also talked about this. There was commercials running up and down. Everyone's talking about it. You went to the dentist. Everyone's talking about, did you hear about this stock? Did you hear about that? This new tech company has a bright future, and will make you a millionaire with no time. And here are the details from my financial advisor, for example, in regards to the IPO. Have a look at it. Everyone's talking about that, and this is usually then a tendency which creates in yourself. So it creates a need that you want to be part of this. And so it's a psychological phenomenon that occurs within a group of people in which the desire for harmony or conformity in the group results in an irrational or dysfunctional decision-making outcome. And this is also something like crooks do. It's a psychological effect they try to use. Once they have someone they want to convince to invest in their great, most of the time it's a Ponzi scheme, but in the great company, whatever. So if you say, well, I'm not really sure, they start to talk to you like, well, if you don't invest, I mean, never mind. It's a great chance, sure, but if you don't want to, if your wife tells you not to, well, probably no problem. But you have to understand that you're then not part of the great community, which all these guys which are already invested here. So these crooks are using a psychological phenomenon which is naturally within us as human beings, and our desire for harmony and conformity in the group here, in fact, and this natural desire then leads to this bandwagon effect. So if everyone else is talking about, I'm already invested, let's say in Bitcoin, or I have already bought tech stocks or something like that, everyone else is going after that. There's also something which is, in my opinion, very, very difficult right now when looking at the current developments in the real estate industry. When looking here at Germany, everyone is going after a house. I want to buy a house. Did you see how these how prices developed here over the last years? Everyone wants to buy a house. You look at the people and you say, I understand that you want to have your own house, and also see the developments, and it's probably part of your pension plan or something like that. But did you realize that you're already 35, 40 years old, let's say, and that it will be pretty difficult at the current prices to, over the next, let's say, 30 years, you will have trouble to pay something like, let's say, 500,000 or back to the bank where you get your money from. I mean, currently money is cheap, so yields are at zero. It's like, I mean, when I was an employee with the bank, I remember yields which were at 5-6% for real estate and those financing structures which there were created. So and you look at them and say, I understand that you want to have a house, and in your opinion, everyone else has one or is buying one, but is it, from a rational perspective, does it make sense for you to buy a house right now? And most of the people I talk to them are usually not really looking at it from this perspective. It's more like irrational or dysfunctional decision-making outcome. Everyone else has a house, I want to have one too. So, and we're talking about a big investment here. I mean, $500,000, and you have a day-to-day job. Let's say you have to feed a family. You won't probably go on vacation. Your children right now are something like, let's say 3, 4 years, 5 years old or something. If they are 10, in 5 years, you buy the house right now, and you can't afford a vacation, they're probably not that happy to, on one hand, work or live in a great house, but then family and the father can't afford a vacation, let's say, or he can afford the vacation, but then he can't pay the loan back or something like that. So, and this is something which is naturally normal. It's something which is within us, and which is here also classic example, something we probably have seen when it came to Bitcoin. Everyone seemed to be long Bitcoin 3 years ago, 3.5 years ago. I want to be part of that. I want to be part of their cycle. And that's why I open an account with whatever broker and I buy Bitcoin. And probably I have to somehow not go the classic, let's call it the spot way or the cash way. So unleveraged, so you buy one Bitcoin, but you go for a leverage product, something like OTC product, CFD, Bitcoin CFDs or something. And back then, it was possible to really hugely leverage your investments here 3 years ago. Then ESMA hit the markets. That was in 2018, in August. And that was when the tide turned here. And now you only have with CFDs a chance of leveraging your Bitcoin CFDs with 2 to 1 as a retail investor. Still, it's something which is classic, and the reason why this parabolic rise happened is certainly to be found in the so-called bandwagon effect here. So, hello. There we go. So now. We come to the question. In fact, should you, or how can you? Let's put it that way. How can you avoid this bandwagon effect in your trading, and or in general cognitive biases? So probably we shouldn't just go down to the herd mentality or bandwagon effect. Probably we should go to cognitive biases in general. As a rule of thumb, we can, without giving now the mathematical reason behind that, but as a rule of thumb, we can say cognitive biases in trading should be avoided. Not necessarily under all circumstances, but it should be something you should be aware of, and it should be something which should be avoided, since trading based on cognitive biases and trading based on emotions will naturally lead to a result which is minus EV, we call this. So it has a negative expected value, in fact, connected to that. So which means nothing more than there might be times, let's say, when you say, I take my gains here in this position because I don't think that the market will continue to move higher, let's say. Now, the thing is that if you do this often enough, you probably self-serving bias in this case, you come to the conclusion that you have a great read on the market because you usually remember the times when it worked out and when you were right here, but you don't remember the times when you were wrong and when you took out the trade and the market continued to work to trade in your initial direction and could have created an even bigger gain on your account. If after summing up all those, let's call them discretionary interventions, if summing up them, the results of them comes down with a minus 10 points or something like that, it has a negative expected value, which means you should avoid doing that. And the main reason for intervening here from a discretionary perspective was because you got emotional and cognitive bias took over here, in fact. So this is what I mean by you should avoid this, and what's the mathematical reason behind that. So this is also something you can see here. If you grasp the concept of expected value, you understand that trading based on cognitive biases will result in bad results in the long term and increase your chances of losing money and going broke sooner rather than later. This is what we refer to as trading with a negative expectancy. Still, and this is where now the experience, let's call it, comes into play. Still, sometimes, like during the .com or Bitcoin bubble, jumping on the bandwagon could be attractive, but you have to be really careful and make sure to exit the bubble no matter what. and once it bursts. So, for example, let's assume that the media starts writing that the current sharp drop is an attractive opportunity to jump on the bandwagon. So it's only a small correction. Never mind. Keep your positions, probably add to them. This is usually what the media then talks about. In my case, I keep on, or it's only a rule of thumb, but for example, my mother, my father, class examples have nothing, not a lot to do with markets. Once my father asked me, let's come back to gold, for example, 2010, 2011, when gold went parabolic up to 2,000 USD. When my father came to me and asked, what do you think about gold? I just heard about a great story on German television, whatever, and I think about investing there, so I'm buying some gold. So it went up quite a lot, and then I think based on what they delivered there in terms of information around the monetary policy of central banks, and I think I'm buying gold. You know what I did? I sold gold. And why did I do that? Because my father, who usually has nothing to do with that, starts to get interested in it. So this is usually a first sign that there's something like a bubble building. The same is true for Bitcoins. When the mother of my wife, that was last year, in fact, when the mother of my wife asked my wife, couldn't you go over to Jens and ask him what he thinks about Bitcoin? I don't want to ask him directly, but probably. My wife told me that. I smiled. She smiled too, and then before I was able to answer, she said, "Well, I don't really grasp this whole concept of this trading and all this, but didn't you say that if my mother starts to talk about it, we should sell it instead of buying?" And that was in fact the point. So you look at the chart that was in June, at the end of June last year. I don't really well remember, but I think Bitcoin was trading something around 13,000 USD or something back then, 12,000. I'm not sure, but it fell by something like 50% from that point. It was nearly the high when my wife asked me. In fact, so no joke. So you can really look this up. So if this happens within your environment, be really, really careful when it comes to jump the bandwagon. Also, when it comes to the current developments in equities, let's look here at the next slide. But also, let's have a look here at the fear and greed index of CNN, for example. When looking at equities, you can see that currently we have extreme greed in the market due to this near parabolic rise in equities. And it seems, when looking at the chart, that everyone is jumping the bandwagon. But is this really true? Look at social media. Look at several feeds, for example, from so-called FinTwits, from tweets or Twitter accounts from people who are in the financial industry. There's so much skepticism that it's, in my opinion, natural. It's not only because of that, because of this skepticism and this, let's call it net short bias, which we have in the market, that the market should come down from there. But on top of that, it's also true that with the support from the central bank in regards to the Fed, for example, but also, for example, US President Trump trying everything to stabilize market at the current levels because it increases the likelihood of him being reelected. If you combine all this, in my opinion, even though we have extreme greed here, and this is a potential sentiment extreme, it does not necessarily mean that we will see a larger corrective move. So as long as this skepticism finds, or you can find this skepticism in the market, as long as you can see that, there's normally no big reason or real reason to believe that the market will sharply decline here. Now let's come to one very important aspect, avoiding cognitive biases in your trading. By the way, I talked so much today that I completely lost the clock here in the background. So I have to hurry up right now a little. Please excuse. I just got completely lost here. I hope so far you enjoyed it. That's probably the most important thing. Let's have now a quick look here at avoiding cognitive biases in your trading. So for example, if you have a winning streak, overconfidence is building, self-confidence, and you feel invulnerable. That's also something you probably have seen. Induce rational thinking, find actively reasons why your next trade could fail. This is a so-called pre-mortem analysis, something which is really, really important. So it's not only that you probably feel completely devastated after a losing streak, but it's the same for the winning streak here. And also understand the math behind it. So we haven't had any formulas right now on expected value in here, everything. But if you grasp the concept of this formula of expected value, you understand that trading based on cognitive biases will naturally result in bad results in the long term and increase your chances of going broke. So you should definitely avoid this. In general, I recommend to formulate a trading plan and a clear idea of what you plan to trade, test it, see whether it works, or in short, mathematically speaking, or risk money management speaking, if the strategy, your approach has a positive expected value and the risk of ruin of 0, go with it and trust it, believe in it, and then keep with the plan, stick with the plan every time over and over and over again. And also, take your time to write down your strategy, and not only that, but every trade you do based on that strategy. Because we also already mentioned that, because if you see the result is negative, then you're measurable, you can see it. But see the positive aspects about around being measurable in your trading, because you have the chance then to know about your mistakes, see that something's not working, and then tackle this and make it better next time. And this is like, it's the long-term target of your trading in general, in fact. And yeah, and this is all where it comes down to, how you can avoid cognitive biases in your trading. So, summary. The bandwagon effect, herd mentality, is a classic cognitive bias which will result in bad results in the long term and increase your chances of losing money, which means avoid it. Still, sometimes, like during the .com or the Bitcoin bubble, jumping the herd can be attractive, at least short term, but only if you're really careful, if you know what you're doing, and if you know when signs intensify that it's time to exit the bubble here. For example, the media starts writing the current sharp drop, for example, in Bitcoin, is an attractive opportunity to jump on the bandwagon, for example. Or your family, which has usually nothing to do with financial markets, starts to ask you in regards to the performance of this and that asset. That's usually not a very positive sign, but in fact, the complete opposite. And the general solution here for avoiding cognitive biases in your trading: formulate a trading plan, a clear idea of what you plan to trade, test it, see if it works, and if it's robust, and if it is, then go with it. That's usually the easiest way when it comes to avoid cognitive biases in your trading. And don't forget to join us next time. So Paul will be here on Monday, and we'll talk to you about combining different price action tactics, including how to increase your trading opportunities, how to build a more comprehensive trading plan, and how to identify better setups. And when it will be same time on Monday, 2 p.m. London time, 20th of January. If you joined the webinar here live right now, just check your inbox, because the link will directly send over to your inbox, and you only have to click it in there. If you watch it on YouTube, I first of all hope you enjoyed it. I hope you don't mind that it took a little longer now. Feel free to click on the link which is delivered in the chat box below. Please leave a thumb up or a thumb down. Probably a thumb up would be nicer here. Register for the webinar for Paul, and yeah, join us every time then right live. And for further analysis, education, go to admiralmarkets.com. Here's also the contact details. And at the beginning, I forgot to mention it, but Admiral Markets is also fully regulated around the globe. It's not only FCA regulated, but for example, also ASIC regulated Australia here. So that's why we have to finish here with a risk disclaimer. And that's it from my end. So all the best. Happy trading. Watch your stops. Have a nice weekend. Enjoy yourself. Talk to you again next week on Friday. I look forward to it. See you, and bye-bye.